Critics have opposed clean energy public investment by claiming that governments must not pick winners, green subsidies enable rent-seeking behavior, and failed companies mean failed policy. These arguments are problematic and should not determine the direction of energy investment policies. A slew of recent studies has made clear that the pathways to net zero greenhouse gas (GHG) emissions by 2050 demand significant re-gearing of the global economy, which will require major governmental funding across the world. 1, 2, 3. These public investments need to go beyond research and development, and support technology demonstration, manufacturing, and deployment, as well as energy efficiency and the build-out of electricity infrastructure at scale. Public finance focused on climate change has grown significantly over the last decade and is currently accelerating further. The European Union's Green Deal, the Biden administration's climate change investment plans, South Korea's green spending, and other government initiatives reflect this shift. To put this trend into perspective, the European Green Deal includes €503 billion for clean energy over the next 10 years, compared to €30 billion of climate spending in the 2008-09 stimulus response over 2 years. Public investment plays a vital role in mobilizing greater sums of private capital to achieve climate goals. Worldwide investments in the low-carbon energy transition were $755 billion in 2021, Ref. 6. Yet this remains far below what is required. Climate finance needs to grow by a factor of almost 6 by 2030 to limit global warming to 1.5 degrees, Ref. 7, Fig. 1. While scaling up public investment represents a major policy challenge, getting public investment right must be understood as important to achieving net zero emissions goals, and governments are creating new strategies and agencies to rise to the challenge. The European Union just launched the European Climate, Environment, and Infrastructure Executive Agency. The United States is considering the creation of a Clean Energy and Sustainability Accelerator, and international development banks are increasingly committed to reorient their portfolios to achieve climate objectives. Yet, policy myths permeate the debate on public investment in clean energy that threaten to discourage the use of public funds to advance decarbonization. These include the beliefs that policymakers should never be in the business of picking winners, rent-seeking behavior, that is, firms seeking excessive government support, will inevitably become pervasive, and failed investments are tantamount to policy failure. In this comment, we challenge these myths as reasons for inaction, argue why each is inherent to good policy, and propose how they can be managed well. Picking winners. Conventional wisdom suggests that governments know too little about market trends to effectively pick economic winners by directly investing in firms and technologies. 8. Economists typically advocate for the alternative approach, that policy should be designed to set a price on GHG emissions so that the private sector itself has the financial incentive to pick its own winners in line with the goal of reducing emissions. We highlight 3 reasons that picking winners is necessary. First, political reality makes it unlikely that GHG price signals will be widely enough adopted with high enough prices in the near future to drive technological change at the required pace in most markets. 9. Indeed, efforts to advance pricing mechanisms at the federal level remain elusive in the United States. Instead, technology-specific and sector-specific policies have emerged as the centerpiece of decarbonization policies in the power and transport sectors. 10, including the Biden administration's climate strategy. These initiatives tend to focus less on policy outcomes, such as emission reductions, and more on policy inputs such as technology choices. While technology subsidies and standards may also face political opposition, especially at later stages. 11, they tend to mobilize more political support than GHG pricing. In many cases, governments thus already pick winners, contrary to much rhetoric. And, even in the presence of GHG pricing, the path-dependent nature of technological change suggests that subsidizing clean energy has an important role to play. 12. 13. Carbon-intensive technologies have accumulated a much greater knowledge stock over time, making investments in them more profitable compared to those in clean energy. Public investment can help clean energy technologies overcome this challenge. Another reason to re-examine the role of government is the need to invest in technologies that require high capital investments today but have great future potential to reduce emissions. In these cases, picking winners means advancing policies that drive down cost curves and thus produce benefits further in the future than the private sector is likely to find attractive today. 14. This market dynamic is particularly true for innovation in hard-to-abate sectors such as aluminum, cement, steel, and aviation, and for negative emission technologies. An important secondary benefit to driving down costs of high capital investment technologies, especially ones that make their way into homes to promote energy efficiency, is that it will help those households that are energy insecure by reducing their energy burden. Studies have revealed those households to be disproportionately low income and of color 15. Finally, picking winners through public investment can help to build the political constituency and community involvement required to further advance climate change and clean energy policies. As governments invest in low GHG technologies, they begin to mobilize beneficiaries, both firms and communities, and thus shift the balance of power from polluters to the economic winners in decarbonization. 16. Picking winners is inevitable and not bad per se. The real question is how to do it well. First, the nature of picking winners needs to change as technologies and markets mature. In early-stage investments in demonstration and initial deployment, policymakers will need to bet on individual companies and consortia. As technologies mature and the potential for different technologies becomes clearer, they should shift to focusing on picking technologies. Then, once various technologies in a sector mature, public support could transition to other, early-stage technologies, and regulatory standards and carbon pricing policies could drive demand for continued deployment of these maturing clean energy technologies. Second, investment decisions need to be more rules and goals-based. This principle argues for setting targets for the environmental performance of investments, including cost declines, efficiency increases, or GHG reductions. For instance, the Sunshot Initiative of the Department of Energy in the United States set a goal for the per kilowatt-hour cost of solar energy. Picking winners thus becomes a strategy to focus and intensify competition toward clean energy. Third, policymakers should focus on technologies that maximize emission reductions over time, as a function of both emission reductions per unit deployed and scalability. Markets by no means can be counted upon to optimize these critical policy dimensions. Fourth, bridging the valley of death, the funding gap in early-stage technology commercialization, should be a priority. The use of advanced market commitments is one proven policy, that is, governments providing an advance contract to purchase a certain amount of a new technology once it is commercialized. This has been successful for vaccine development. 17. IBM only needed one major government contract to move forward with the development of the personal computer. 18.